Good morning friends, welcome to Ecoholics YouTube channel. My name is Avinash Agarwal and in this video I will be discussing with you important current affairs for 30th May 2024. There are three important topics that I want to discuss with you. First is related to minimum wage. Is minimum wage helpful to those who are the lowest skilled employees? Is minimum wage helpful to those who are least productive? Is minimum wage helpful for, let us say, somebody who is doing absolutely unskilled labor work? That is an important question to answer, because we create minimum wage laws saying that it will be beneficial for laborers. Will it actually be beneficial for laborers or not? And which kind of laborers will benefit from minimum wage laws is what we will discuss in the first article. In the second article, we will speak about the idea of retailing government securities. So RBI created this platform whereby ordinary people such as you and me can also directly buy government securities. So that platform, while it is well intended, it is not getting a lot of traction. Not a lot of people are using that platform to, let us say, purchase government securities, trade government securities, especially if you compare the numbers with, let us say, that of mutual fund investors or stock market investors in India. So why is it that that platform is not doing so well, and what are the kind of steps that we can take so that we can improve the traction of that platform, so that we can improve the numbers of people registered on the platform? So that is the second article. The third article will talk about increasingly positive outlook for the Indian economy, as reflected in not a ratings upgrade, but the change in outlook from neutral to positive, which has been done by S&P for India. So as you may be aware that S&P is a global credit rating agency. It gives sovereigns also a credit rating. Sovereigns means government. So they have changed India's outlook from, let us say, neutral to positive. So what are the underlying factors that have helped India achieve this positive outlook is what we will be discussing in the third article. These are the three important articles which can become three important questions in your examination. This note will be available on Ecoholics app, which you can download and do a free registration and therefore access this note. If there is any question that you have for me, please feel free to ask in the live chat or the chat after the live session, and I'll be happy to help, happy to answer. So let us start with our discussion. Thank you for joining in. Good morning, Charulata. Right. So it's lovely to have you almost on a daily basis in the class. So let's talk about minimum wage. Does it help or does it hurt? And whom does it help is what we will answer. So the important point that will come out of this article is that only those who are, let us say, having certain skills or having certain advantages are helped by minimum wage laws. Less skilled workers, they don't benefit. You start this discussion by talking about a quote from Mahatma Gandhi. Mahatma Gandhi had said that recall the face of the poorest and weakest man you have seen and ask yourself if this step you contemplate is going to be of any use to him. This is Mahatma Gandhi's quote. Now, the author adapts this quote for the purpose of this article. The author wants you to imagine scenarios where you are hiring domestic help, car cleaners, security guards. And the author wants you to imagine that, let's say that you are asked to pay these fellows 1 lakh rupees a month. You have a domestic help, a car cleaner and a security guard, and you're offering 1 lakh rupees per month to them. If you have to offer 1 lakh rupees a month to them, would you still go ahead and employ them in today's times? And the answer will mostly come out to be no. Except for, let us say, big business families, CEO homes, or in those kinds of HNI categories where there is a lot of money available with the family, etc. to spend, they will still hire. But normal people such as, let us say, you and me may not go ahead and hire these kinds of workers. Okay, why is that the case? So, well, if you are, let us say, an ultra rich, or if you are, let us say, a CEO, then probably your domestic help, your cook, your driver is having certain extra skills, has gained your trust, so they have an edge, right? Maybe they are very well polished, well groomed, etc., highly skilled in required skills, let's say, in being able to handle your guests well, in being able to handle your requirements well. So they will be able to, let us say, still make this kind of a pay packet, but most others will not be able to secure employment given this hefty salary that needs to be paid out. Now, this thought experiment has been continued further in this article, and humor me, this is actually going in a very good direction. Let's say that you don't have to pay 1 lakh, let's say that you have to pay only 20,000 rupees to these three types of workers. Okay, still a lot of people will not be able to work as domestic help, as drivers, as watchmen, because a lot of people will not want to pay 20,000 rupees. Let's say that if you are upper middle class, etc., and you have a decent amount of income and wealth, you may still hire, but then there will be a lot of people below that particular strata of society who will feel that 20,000 rupees is way too much. So what is happening? So the idea over here is that if you set an arbitrary minimum wage benchmark or a condition, then what happens is that a lot of people who don't or can't really justify the work that they are doing to their employers at that particular salary benchmark or that particular wage benchmark, they start losing their jobs. That is what happens. So the idea that is, getting developed in this particular article is that, let's say that you talk from an internship point of view, that if interns are paid interns, then would you want to take on interns? Probably no. So you would still want to take on interns if they are fantastically talented. Let us say, an IIT IIM kind of a grad, or somebody who's having exceptionally good skills, proven skills, track record, has really impressed you. Those kinds of interns you may still hire because they are worth it. Others you may not hire because you have to pay for them. Now, this is not just some author's flight of fancy. There is proven research. There is good amount of scientific evidence also which suggests that minimum wages may not really help as much as we think they should help. For instance, there is this 2006 review of minimum wage research which has been cited in the article, which says that a lot of studies have been done and they show a negative effect on employment because of imposition of minimum wage. That there is very strong evidence that the disemployment effect is strongest for those who are having the least skills, right? Because their jobs can be easily, let us say, mechanized or done by machines. If minimum wages are imposed, probably, then mechanization is the way ahead. A lot of randomized control trials have also been done on this topic. Higher minimum wage raised the wages of hired workers. However, there is a reduction in hiring and there is a large reduction in hours worked. And firms then tend to hire productive workers, which adversely affects less productive, less skilled workers. If you see anecdotal evidence, if you see the transition in China, the author says that China was able to move 35% of its workforce from agriculture to manufacturing and services. 30 years later, after 1991, India has moved only 13% of its workforce from agriculture to manufacturing and services. And the author believes that one of the major reasons is rigid labor laws, including minimum wage laws in India, that didn't allow this kind of transition to happen, that didn't allow these kinds of jobs to get created. So then what is the solution as per the author? What does one do to really protect those who are working as laborers and drawing wages? How do you ensure that they get minimum wages, decent wages? How do you ensure that? So the author believes that the best way is to create a lot of work related options. And again, there is a thought experiment over here that let's say that you offer a 50% lower salary to your domestic help, to your cook, to your guard. Will they work for you? Probably not. Immediately they will find somebody else in your neighborhood who is willing to pay them better wages and they will shift jobs. That is what the author believes is the solution, that create competition for their services, create jobs, maximize their choice, and that in itself will alleviate the problem of low wages, alleviate the problem of discriminatory wages. So if you want to really transition from, let us say, a poor to a middle income or a rich status country, then you need to create choices. That means you need to create jobs, and to create jobs you need to have liberalized and relaxed labor laws, is what seems to be coming out of this article. Now I just want to tie this article back to the discussion on minimum wages and living wages that we had done around 10 days ago. There was another article that we had discussed on similar lines where we were discussing that government is reviewing the minimum wages that are getting paid in India as per law, right? And we are expected to start paying living wages. We are collaborating with ILO officials to discuss all of these things. So if you remember that discussion and you remember this discussion, then you have been given two diametrically opposite sides of the coin. They have been explained to you, and in the examination, one side of the coin was showing all the positives that can come out of paying living wages, paying higher minimum wages in India. And then there is this article which is on an opposite extreme, which is talking about how that can be seriously detrimental to those who are at the lowest skill band level of employment, right? So with this entire spectrum of knowledge, you should be in a very strong position to be able to tackle fairly difficult questions in the examination. That is the important takeaway out of this article for me and for you. I hope that this is clear. If there is any doubt, please feel free to ask. I'll move ahead to my next article. GSEC Retailer. So the platform that RBI had launched was Retail Direct Facility. Now through this Retail Direct Facility, you and I as retail investors can buy sovereign bonds directly from the government and trade them online. So what this will do is that this will enable participation by us in the primary and secondary bond markets. What is a primary market? Primary market is a market where freshly issued securities are offered for the first time to investors. What is a secondary market? Secondary market is a market where already issued securities or older securities are traded between investors. So primary security is first time offer. Secondary market is basically a market where already issued securities change hands multiple number of times between various investors. Some become buyers, some become sellers. So this initiative, this Retail Direct Facility, is an initiative of 2021. On paper, it is a win-win kind of an initiative. Both the parties involved win, the government wins as well as the investor wins. How? Government wins because they get a larger pool of creditors who will buy securities. So typically government depends upon banks, institutions, mutual fund houses, etc. to buy their securities. Government, as you know, issues these securities because they have a borrowing requirement. They have a deficit which they want to fill, and that deficit gets filled by issuing these securities. So you get a larger number of buyers in the form of retail investors through this platform if you are a government. And if, let us say, you are an investor looking to invest your money in very safe, very long term, very stable kinds of assets, then government securities may be a very good option, especially if they offer you a rate of interest which is going to be, let us say, slightly higher than fixed deposit rate of interests offered by banks, right? So retail investors, they get additional opportunities to invest in central papers, treasury bills, state government bonds, and sovereign gold bonds, etc. So if you're an investor with a long horizon and looking for risk-free investments, this is the way to go. Government security returns can be quite competitive, especially if you know how to ride the interest rate cycle. What do I mean by riding the interest rate cycle? So typically what happens is that as interest rates increase, right? So you will see as interest rates increase, you will see that bond prices will go down, right? And the yields will go up, and vice versa, right? That interest rates decrease, bond prices go up and yields go down. Now, the primary takeaway from this article is the difficulty in understanding these relationships that I just mentioned so casually over here. It is extremely difficult for a layman to get a sense of these movements in interest rates, in bond prices, and the yield. So the next part of the article actually discusses why is it that this kind of a platform has not seen the momentum, has not seen the volumes that we thought it will see. For instance, this is the kind of data that is helpful. This platform has only 140,000 registrations so far approximately, and only about 125,000 accounts opened so far, whereas millions of new demat accounts have been opened in the same time period, millions of new mutual fund portfolios created in the same time period. So what happens is that if you compare bonds, which government securities typically are, so if you compare bonds with shares, so there is a very different kind of an ecosystem. In the share market, there is glitz, there is glamour, there is there is 100% hike in the last 1 year, 500% hike in the last 3 years. Those kinds of ideas. There are, people who are sitting on YouTube and teaching you how to trade in bonds based on fundamentals, based on technicals, based on this, based on that. There are influencers who are talking about equities on a day in day out basis, multi-bagger, etc., etc. So the kind of glitz and glamour that you see in equities unfortunately doesn't exist in the bonds market, right? These are basically very safe fixed income instruments, right? And typically there is a lot of unfamiliarity with these kinds of instruments. There are multiple series of government securities which are getting offered at various prices. There is a coupon rate of interest associated with these securities, and understanding what you will actually get out of, let us say, 1 lakh rupees invested in a particular security, it can be a fairly complex calculation, because it ultimately depends upon the yield that you are making. What is yield? So every bond, it gives you a fixed income, right? Let's put that fixed income in the numerator. Every bond has a price. Let us put the price in the denominator, right? And then you multiply it by 100, right? It's as simple as that, basically. But it can be fairly complex, because for every bond there is a different fixed income, for every bond there is a different price, and that you have to multiply by 100. And this particular calculation is applicable only for the remaining tenor of the bond. So you need to check the tenor of the bond, that how long is this bond going to remain activated. So as you can see, that these are fairly difficult calculations which can be done but may not be done so easily by the layman. Now if you look at the RBI's app offers all of these things, right? But it is still very difficult to understand. So there is therefore a requirement that we need to redesign not only the app, but probably also the supporting ecosystem around it. It needs to be more user friendly. It needs to use much less jargon. It needs to offer, a much more educative kind of an experience for first time investors and for repeat investors who are really new, so that they get a hang of what they are doing on that particular app, on that particular platform. And maybe the government can think in terms of offering tax incentives for such kinds of securities, so that people flock, in larger number to these kinds of securities, if that actually makes sense, right? That's just a suggestion. These are all out of the box ideas. So it's a small question that can be asked to you in the examination regarding, let us say, what do you understand by a retail direct facility? What are the advantages, or why was it launched? What is the value proposition for launching it, and how is it performing right now? So all of these questions and sub questions can basically be answered out of this one simple article, right? That's the whole purpose of these discussions, that we are trying to preempt the questions that can get asked in the examination, and we are trying to provide to you a decent amount of knowledge that can be therefore helpful in the examination for you. If there is any question, please feel free to ask. Otherwise, I will move ahead. Next article is talking about S&P, Standard and Poor. So they have basically increased or they have raised India's outlook to positive from stable after 14 long years. So this is basically, pointing towards probably an sovereign ratings upgrade. What is sovereign ratings? Let me just explain this to you. Right, I have highlighted this in blue so that the definitional aspect is very clear to you. So what is a sovereign credit rating? So sovereign basically refers to a country or a government. Credit rating, what does credit mean? Credit means the loan. Rating means that how safe is this loan? So let's say that government of India goes out there and takes a loan. So government of India is a sovereign. They have taken a credit. Now how safe is that credit that has been given to government of India? Will government of India be able to repay the interest? Will they be able to repay the principal? Will they be able to do these things on time? These are the things that get reflected in the rating. Okay. So sovereign credit rating, it measures a government's ability to repay its debt. Now you know it as a matter of fact that we have never ever defaulted on the debts that we have taken. Okay. So a higher rating indicates greater trust in the ability to repay, right? And therefore lower borrowing cost. Now as a matter of fact, India, which has never defaulted in its history and will probably never default going ahead in the medium to long term, we should have a decent rating. We should have a high rating. There should be trust in us, right? We should face lower borrowing costs. Unfortunately, it's exactly the opposite of it. We don't have a high rating. In fact, we have the lowest rating in the investment grade. Lowest rating in the investment grade, meaning that yes, you can invest in India, yes, you can lend in India, but it is the lowest possible rating that can be given and that has been given to India. There is trust as reflected in the inflow of FDI and FII into our country. There is trust, as you can see that there is a significant amount of foreign investors putting their money in government securities. There is a lot of trust, but the borrowing costs are not low for India. The rating is not high for India. That is what this particular article will talk about. This is a recurring discussion in economic circles. This can very well be a question in the examination, because economic survey after economic survey, in the recent 2-3 years, they have talked about this topic in quite a bit of detail. So what is happening over here is that there is a ratings upgrade, right? Based on India's sound economic fundamentals, growth momentum, government spending, and sovereign credit ratings in India, they are, like I mentioned, at the lowest investment grade level of BBB minus or A3. Why is it that we have gotten a positive outlook now from S&P? Also because of cautious fiscal and cautious monetary policy. So there is policy stability, there is deepening of economic reforms, there is infrastructure investment. Our long-term growth prospects are good. Because of all of these positive steps, or because of all of these positive developments, we have gotten a positive outlook. Please remember that we haven't gotten a rating upgrade so far. There are two things that these rating agencies release. There is a credit rating and there is an outlook, right? So for outlook, we were at neutral. Now our outlook has been changed to positive. That means that in the next 2 years, S&P believes that India is going to be on a decent, on a strong, on a healthy economic trajectory. And what are the reasons? Why have they suddenly changed their outlook from neutral to positive is what I have elaborated over here, right? As well as over here. These are the points that should be at your fingertips. Strong economic fundamentals, growth momentum, good government spending. Apart from that, policy stability, cautious fiscal policy and monetary policy, deepening economic reforms, high infrastructure investments, and long-term growth prospects. These are the standard things that should be available to you. When you have decent growth prospects, that means that the government's revenues are going to be decent. Therefore, the government will be in a strong position to take care of its debt and interest burden. That is the kind of logic that you should be able to apply. So, economic health has considerably improved. Nirmala Sitharaman has given a similar kind of a statement after this news came out. So, I'm just going to leave that repetitive part aside. We are expected to have solid consumer and public demand, public investment dynamics, right? So we are expecting a GDP growth rate, real GDP growth rate of 6.8%, 6.9% and 7% going ahead. Now, there are certain, like I mentioned, that this is a recurring discussion, a recurring topic of interest in economics circles. So there is a lot of literature around how discriminatory these credit rating agencies are, how opaque they are, how non-transparent they are, how subjective they are, how they are not actually reflecting the ground realities of developing economies there. So there is a lot of literature out there. Okay. For instance, there is this quote which has been given by one of the economists that rating methodology which is used by these agencies, they are unable to keep pace with the dynamic and pervasive transformation of the Indian economy. That Indian economy is a very different economy than what it was, let us say, 40 or 50 years ago today. It's high growth economy. It's a vibrant economy. There is very strong demand. There is very good rule of law, etc. Right? We are a premier destination for foreign investments. We are leading recipients of foreign direct and foreign portfolio investments. And unfortunately, and we have been this for the last 15, 20, 25, 30 years continuously for a very long period of time. Despite this, we are having very bad ratings as compared to other countries. So that is what the problem over here is. If you go by the statement of government's chief economic advisor, V. Anantha Nageswaran, see, he has stated that credit rating agencies, they need to reform their processes. They need to correctly reflect the default risk of developing economies. For India, the default risk is as close to zero as it can be. So that should be reflected in our ratings. We should have higher ratings and therefore lower borrowing costs, but that is not happening. Now, because of this opaqueness, right, things are not up to the mark. And it is challenging to quantify the impact of qualitative factors on credit ratings. It is very difficult to do this. So we need to have a relook at their methodologies. We need to have a relook at their processes. To earn a credit rating upgrade, developing economies must demonstrate progress along arbitrary indicators, is what Nageshwaran is saying. And these are the kind of statements, these are the kind of rebuttals that should be a part of your answers, that should be a part of your thought process. We need to really understand these arbitrary indicators. We need to understand how the process is opaque. I just need 3 or 4 points around these things and I'm good to go. I'm really expecting a question based on this particular news that India has achieved a positive outlook from, let us say, an S&P. What does that reflect? And maybe also discuss the recent debate regarding the entire sovereign credit rating process that has been followed across the world. So rating agencies, they are using growth, inflation, government debt, short-term external debt as a percentage of GDP, and political stability as factors. These are the important factors that a rating agency looks at. But if these are the important factors that a rating agency looks at, and if India has been performing reasonably well on these factors, so why is it that we still have, the lowest grade in the investment bracket countries? That is something that we really need to understand and wrap our heads around. This particular article is just the start of a discussion on this topic. I am expecting certain analytical opinion columns, etc., coming in the days ahead, which I'll be bringing for you guys, and that will kind of help you in understanding this entire mystery, that will help you in understanding this entire topic. So this is my submission today. I hope that you have learned something new and it made sense to you. I'll meet you again tomorrow. Until then, thank you so much. All the very best. Jai Hind, and take care all of you. Thank you so much.